In this section, an example illustrates how to apply accounting principles. The example is previously introduced in the balance sheet fixed assets section, where a laptop is bought for $1,000 plus $210 VAT, so a purchase price of $1,210. Let's suggest that the company pays the invoice of $1,210 immediately in the computer store. The cash outflow of $1,210 is recorded on the cash flow statement. The bank account on the balance sheet will decrease with $1,210. The claimable VAT is not an expense and is not recorded on the income statement, but as VAT input, a balance sheet current asset. On the balance sheet, the laptop is recorded as an asset on the debit side for a value of $1,000. The balance sheet total does not change if the purchase of the asset is paid immediately. If the laptop is purchased on credit, a liability of $1,210 is recorded on the credit side of the balance sheet as an account payable. In this case, the balance sheet total increases. Only if the invoice is paid, there is a cash flow statement recording. On the balance sheet, the asset bank account and the liability account payable both decrease for $1,210. Please note that because there are no costs and expenses, there is no profit or loss recorded on the income statement and equity does not change. But, of course, an investment will have impact on the income statement in the future. The laptop will be used for 5 years and the estimated residual value is $200. So depreciation is $1,000 minus $200, equaling $800 in total. Thus the yearly depreciation expense recorded on the income statement equals $160 per year, or $800 divided by 5 years. Every year the laptop will decrease in value on the balance sheet with $160. The depreciation expense is not a cash outflow on the cash flow statement. Depreciation is recorded as expense on the income statement for $160 per year and will decrease equity for $160 per year. On the balance sheet, the laptop shows a value of $100,000 at the start of the year. At the end of year 1, the laptop value is depreciated with $160 to $840 and after year 2 to $680. To summarize the effect of recording due to application of accounting principles, revenues and expenses are recorded on the income statement and impact equity on credit side of the balance sheet. Receipts and payments are recorded on the cash flow statement and impact the bank account on the debit side of the balance sheet. This is enough about account principles, cash and income. If you have any questions about this section, please don't hesitate to send me a message. In next section, you will learn about red flags that signal potential money laundering by manipulating valuation, revenue and expense.